Now, last week we talked about expensive options. This week I want to talk about cheap options. So we're into the Q3 earnings season, getting well into it right now. We've seen some major companies that have reported. And last week we talked about options that are expensive and trying to find selling strategies around those options. This week I want to do the exact reverse. So what is cheap? How do we rank cheap IV? What I do is I look at it, and I like to talk about this in terms of the weather. So weather here's cooled off a bit. Last week we were in the 90s. You know, typically the weather in Florida, we have two types of weather, hot and hotter. But, you know, all joking aside, we do cool off. And so we have cooled off. We were in the high 50s for a couple of days last week. And, high 50s to high 80s. So it's starting to cool off. But if I were to take record, 1 year low, let's take a 1 year low in Florida. Let's just call it 40. And let's take a 1 year high in Florida. Let's call that 100. So we can rank today's weather compared to where its yearly averages are. Yearly average 40, yearly average 100. If my weather is 95 degrees today, I'm hot. And I'm closer to the high than I am to the low. And subsequently, if we drop down to 45 degrees, we're getting close to the yearly lows for this particular state. We treat options implied volatility the same way. What we do is we take all optionable stocks. Every day, we're able to look at the near money calls and near money puts, and we put those together and we create an average ranking for those near money calls and puts. And so what we do is we timestamp that and we hold that data for years. I typically look at the last year and I look at three things. I look at where has it been in terms of being expensive for the last year? Where's it been in terms of being cheap? And where is it right now? And we're able to look at those and run reports every day to find those cheap and expensive options. So I want to share with you what we see as cheap today. Again, remember, cheap is ranking of implied volatility against a set of near money options over the last year. And cheap IV is the implied volatility that's closest to the lows. So when you look at this, and this is come right off of our software as of this morning. So USB has had a 1 year high of 38.86, a 1 year low of 23.03, and look at today, 23.03. And I would say, the first few are definitely going to be in that camp. Charles Schwab had a high of over 40 for its 1 year average implied volatility. The low was 22.35. Today, 22.35. New 1 year lows for Schwab. Netflix. So Netflix had a high of 57.92, a low of 26.16, and it's currently at 27.04. That's what puts it in rank number 3. The rest of the list, ISRG, CMA, CCI, SLG, ARR, EPR, and rounding out the top 10 cheapest options, by the way we rank them, is TFC. As you can see with all of these, we're looking at that current and how close that current is to the low. All right, let's take a look at two of these. I want to look at Schwab and I want to look at Netflix. So this is Schwab. And we're going back, and now I go back an entire year, but what you're looking at here is just a 6-month chart of the options, and you can see where they were as far as their 6-month lows down here in the mid-20s. We had a high that came in August, and then here's the high that was just a week or so ago up near 40 for that IV. Once the earnings came out, though, boom, Schwab jumped in price. Went from 68 to about 72, 4 points. But what really dropped was going from about a 40 IV down into the low 20s. The time value, the extrinsic value of the options on Schwab dropped nearly in half after the earnings report that came out about a week ago. What does that mean for options? All right, so we'll look at 90-day options, or, 60-day options. We're looking at 60-day options. So these are the options that expire in December. These are December 20 options. And if Schwab is trading just above 70, call it 71, take a look at the call options, the December 70s, they're $3.40. Now look at the intrinsic value there. You guys see that? $2.45. So $2.45 is the actual option value. Last week, these options, that time value was almost twice as much. So if everything were to be exactly the same, we would have almost $5 of that option value and then have to add that intrinsic value to it. So that's the way we look at these. You look at that extrinsic value, and it's based on, see, this is a 24 vol. If that were a 40 vol, okay, we wouldn't double that. But you know where I'm going with this. Just shows you how much more expensive that time value actually is. So that is the Schwab options you can see here. And what I did was I highlighted these in green so you can see them. They're not green, supposedly, when I'm looking at options data. I just highlighted this so I could go to it with my eyes and show it to you. All right. The other one I want to look at is Netflix. So here's Netflix, same situation. You got Netflix lows for the year were all under the IV of 30. Left-hand side is the stock price. Right-hand side is the 7 to 149-day implied volatility. You can see back in July, that volatility got quite high, all the way up here to 55. After earnings, it dropped down into the 30s. Then we had it pop up a little bit, but that's because, again, what ended up happening was Netflix was dropping as a stock, and it dropped from 660 down to below 600 before it rebounded. Well, when a stock drops, it's going to see a little bit of a surge in an IV. But the big surges in IV come right before earnings. Here's the earnings report that popped out for Netflix. Netflix was trading around 700. It jumped to 740 and then proceeded to close at about 760, which is close to where it is right now. But look at that IV from 50 down to the high 20s. So it too dropped almost half in value. What does that mean? That means if you're looking at the December 760 calls, they had 34 points. They have 34 points right now of time value. That means that they had possibly 50 points of time value before the earnings report came out because, again, that IV was almost twice as high. All right. So, like last week we talked about options that you could sell, right? This week we're talking about options that you can buy. But just because it's on a buy list, just because it's cheap, doesn't mean you just run out and buy it. You have to make sure that those options in that cheap list, the only way I buy them is if there is a reason to buy them. All right, is there's a reason to buy them. So if I'm looking at Schwab, is there another reason other than the fact that those options are cheap that I want to be looking at buying? Netflix, is there a reason that I might want to buy the call options on Netflix? Or am I looking for Netflix to jump much higher than that 34-point option? Do I want to spread those? But again, I only look at if I'm looking at this list, I want to see, are those assets on that list, or is there anything on there that's hitting a bullish or bearish signal in one of my strategies?